Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. There are two major patterns running this market higher since about July. The first is the March to July shallowly bullish shift pitchfork. Notably the middle tine as a support proxy below the market. That's currently at 717. And specifically during this week the upper tine, currently 804. Now this upper tine magnificently capped the market 11 weeks ago. Then again, though breached mainly this past Monday and Tuesday, it still managed to cap the market this week as well. It is, as I've previously said on many occasions here, and I quote, "This is a shallowly bullish pitchfork, but one should not underestimate its power." The second pattern is more recent. It is the July to September bullish shift pitchfork. In this pattern, we are most recently seeing the market channeling higher in between the lower tine, currently at 740, and the middle tine, currently at 809. Here, notably, the middle tine was tested back in early October and held, and again this week, in conjunction with the earlier mentioned upper tine. What was most interesting in this recent testing was that beyond the 2013 high at 809, we simply had little resistance, bar a lesser Fibonacci level at 834, up until 845. So one can reasonably presume that it was these two pitchfork tines that have capped the market this week. Now, if you recall, I spoke at length about these two tines and the crossover that happened this past Monday. Now I quote from last week. "This move up, though bullish, has been tempered by two things. Firstly, the approach to the previously mentioned upper tine of the March to June bullish shift pitchfork and the middle tine of the July to September bullish shift pitchfork. Secondly, and perhaps more importantly, these tines cross over on Monday. Now I know that these are not directly related tines, as in one is an Andrews pitchfork tine and the other is a shift pitchfork tine, but both are from the same move. However, they are to me indirectly related tines, and the crossover period should be viewed with caution. In related crossover of tines, you usually see one or more of the following: a change of trend, a reinforcement of trend, or a period of general volatility. I'm not certain if we may have one or more of these things happen around about next Monday, which is this past Monday, but it is probably prudent to be prepared just in case." End of quote. To be honest, I think that's a suitable place to conclude for this week. Chicago corn. The move down below the long moving average, currently at 564 9 weeks ago, looked like a seminal moment. It was the first proper break below the long moving average since November 2019. Well, it was a major move and the market did try and exploit it dipping lower, but it was lower only in a limited fashion. In a large part, I suspect this failure to really move down was due to prices hesitating around the key combination of the 61.8% absolute Fibonacci line at 525, which is also the 2014 high. Eventually prices did construct two main patterns, a sideways triangle and a descending triangle. All this I had previously discussed, but to recap, the sideways triangle was formed on the top side by the 2 points of broken downtrend, currently at 529 from the start of July, and below by the broken, well broken indeed, July to September uptrend, with at the time its now departing partner the same long moving average. This had a potential target X on the downside in the 509 area, which was achieved 8 weeks ago. Meanwhile, the descending triangle, utilizing the same June to date downtrend on the top side, but then had a flat base made up of the previously mentioned key combination of the 61.8% Fibonacci line at 525, which is also the 2014 high at the same level. This now has initial target X1 below in the 475 area, with a secondary target X2 in the 425 area, right on the 50% absolute Fibonacci line, which is why you can still see them labelled on the daily chart, though I'm currently contemplating retiring them. So all well and good. However, the market had some other ideas, and over the past 4 weeks prices have risen over the 61.8% Fibonacci combination, over the downtrend, over the medium moving average, currently 549, and last week over the long moving average. The first time back up over this moving average for 8 weeks. So what did this all mean? Well, I laid out an explanation last week which is still valid, and I thought I'd quote it. An obvious choice would be to see the drop down at the start of September as a false break lower. I can see the point of that. However, these markets are like life. They are usually a lot more complicated than that. And I think this may be the case here. You see, the move back up over the mid-September, mid-October period seems to have been a disguised period of indecision, with many indecisive daily reactions and counters to the previous session's moves. Additionally, over all of this, we still had a seeming reluctance for the market to head down below the 61.8% Fibonacci line. And also the 2014 high combination. That's all at 525. What the market saw until this week, now remember this is last week I'm talking about, were prices being squished between a declining downtrend, that's currently at 529, and this combination support at 525. I had said repeatedly here that by the second week of November that gap would cease to exist, and thus we need to look to see whether this descending triangle would cause a fresh break higher or lower after the recent number of false starts. End of quote. Now I continued last week with another possible scenario, and again I have to quote this. On top of all this, there is one other option that made itself available. It was to look at the July to date action as a possible descending wedge pattern. There is merit in this, with the lower trend line well below, that's currently at 476, and this week's move up, now remember this is last week, being a break upwards and away from either the descending triangle or the descending wedge pattern. End of quote. Hence 2 weeks ago I gave some thoughts on potential targets on the upside. For first the descending triangle scenario. Thus we have an initial target X3 in the 605 area and a secondary target X4 in the 641 area. I can easily see that target X4 is quite an ask, but target X3 has been, I suppose still is, doable. Now let's look at potential targets for the descending wedge pattern on the top side. Well, unsurprisingly, the initial potential target for this pattern ties in with target X3 at 605. However, the secondary target for this pattern is lower. Target X5 for this pattern is in the 626 area. All this was fairly clear, but this week we've seen the market seemingly peak at the lesser Fibonacci level at 588 and drop back down to the long moving average support where we're currently sitting. Is this a fresh move lower or just an ammunition gathering exercise before a further attempt higher? To be honest, I'm not so sure of either right now, and I would like to see more action to help clear this up. I think I'll leave it there and watch to see if the recent moves higher, the ones before this week, turns out to be true or false. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.